Welcome to EDU World Space.
When the Fed buys bonds in open market operations, you need to think about what they're actually doing. When the Fed sends traders to the open market, these traders have to use United States currency to buy bonds on the open market. When they use these federal dollars on the open market, that increases the money supply as money flows from the Federal Reserve to the money supply. Now, if the Fed reduces the reserve requirement, what does this actually mean? This means that banks have to hold on to less currency, which means that banks can then lend out more money. When banks lend out more money, the money supply goes up, and you can think about more money being in people's pockets. Now, if the Fed increases the interest rate it pays on reserves, this is a little more nuanced. So when the Fed pays on this interest rate on reserves, the Fed is going to pay banks more to hold on to more cash. So it's going to pay banks to hold on to more cash. So because the banks like this, they're going to hold on to that currency, loan out less, and so less money will be loaned out, which means that the money supply will be decreased. Next, if Citibank repays a loan that had previously taken from the Fed, what does this mean? Well, this means that banks, in this case Citibank, is going to pay back its loan to the Federal Reserve. Well, that money was once out here in the money supply, so it flows along here. So we can see that that'll actually decrease the money supply. Okay, let's pretend that a rash of pocketing happens and people decide to hold on to less currency. Well, what is this actually going to do? Well, people are scared to hold on to cash. So what are people going to do? They're going to put their money in a bank. If they're putting their money in the bank, that means that there's less cash in their hands, more in the bank, and that means that banks can then loan out more money for mortgages and things like that. What is it going to do to the money supply? Well, that's going to increase the money supply. All right, imagine again, people here, they're fearful of bank runs. They're going to try to pull all their money out at once. Okay, well, bankers are going to react to that and they're going to hold on to more excess reserves. They're going to hold more money within the bank's wall. What's that going to do to the money supply? Well, think about it. Banks are going to lend out less money, and so there's going to be less money out there. So we're going to think that's going to decrease the money supply. Lastly, if the Fed increases its target, open market operations increases its target for the federal funds rate. Remember the federal funds rate, that is the rate that banks loan one another when they are short on cash, or these very short-term loans. So if the Fed is increasing its target, what does that mean? Well, if its target is to increase that rate, so that it wants banks to have a higher interest rate that it's loaning one another, that means that they are trying to decrease the money supply. That's the ultimate goal. But remember what the federal funds rate is. The Fed can't actually control this explicitly. They have to engage open market operations that will help bring this rate up. So they're going to take some of these actions that we've already talked about to try to raise the federal funds rate, all of which will decrease money supply. Because as banks have to spend more money to loan each other short-term cash, they're going to just hold on to that money, and that's going to decrease the money supply.